Good morning, everyone. I'm Sadie Carrera, a compliance supervisor at Anders CPAs and Advisors. While Brad just finished covering who is required to collect and report and when you collect and report, I'm going to begin to cover what you collect and report. So I feel a good place for us to start is what are the transactions that's going to go on our small business law? What's included? Well, the rule refers to this as a covered application. And what's included in covered applications? Well, everything Brad just discussed under covered transaction or covered originations, with a few extras. Now we're talking about applications. So those non-originations. We're talking about denials, withdrawals, approved, not accepted, incomplete applications. Now, under a COA, the definition of application really hasn't changed. That is still an oral and or written request made in accordance with procedures set by the financial institution. So what else is included on top of what Brad had discussed and now applications or the non-originations? Well, as Brad also mentioned, we had reevaluations, extensions, renewals, and modifications that increase the loan amount. So you already granted a loan, you're just renewing it or doing a reevaluation, and now you're increasing that amount originally granted. You're going to report those transactions to the extent of the increased amount, but we'll get to that a little later. You're also going to report non-HMDA reportable commercial purpose transactions. So my HMDA reporters out there are definitely at an advantage with this new rule. So some of those examples of non-HMDA reportable commercial transactions, how about those construction phase business purpose applications or loans? How about those business purpose applications that met that temporary definition under HMDA? You know, was it going to be satisfied and replaced by permanent financing at a later time? Those wouldn't be reported under HMDA, but they would be reported under this new rule. And then also those applications that are primarily for a commercial purpose that did not purchase, refinance, or improve a dwelling. That would have been one of those other purpose under HMDA, which are non-reportable for business purpose transactions. Well, they will be reportable under this new rule. So for example, a commercial loan that was secured by a dwelling, it wasn't purchased, wasn't refinancing, wasn't improving a dwelling, but you were using all the funds to pay off a business purpose credit card. Those would be reportable under this new rule. And then finally, we have our agricultural transactions, all the farm loans. Those are going to be reportable under this new rule. That's what's included under a covered application. So we can talk about what's excluded. Well, what's excluded would be any reevaluation, extension, or renewal that did not increase the amount that was originally granted. So for example, those transactions that would modify an interest rate or extend the maturity, you know, those would not be covered. You're not going to be reporting those. What also is excluded? How about our inquiries, pre-approvals, pre-qualification requests? And those are pretty extensively covered under what that definition is under a COA. And then participation loans, where your institution is not the originating lender, those are excluded. Those are not considered covered applications under the rule. So now let's get into the nuts and bolts of the rule here. What are we actually going to be reporting? We're going to be reporting all these data fields. Now I'm going to give you as much detail as I possibly can under the allowed time. And we all know there are a few years before most of our viewers are going to be required to report this information. So please be on the lookout for another more detailed webinar as time goes on. Our data fields. We have 23 main data fields with 81 potential fillable fields on our small business law. Again, my HMDA reporters here are at an advantage as there are 110 reportable potential fillable fields for HMDA. So we're much better here, but you will already know many of these fields that I'm going to go over. A lot of them are very similar. So let's start out. On this slide, we talk about a few. The first is going to be our unique identifier. The unique identifier is going to identify each individual transaction. Okay, they all have to be different. We have a max of 45 alphanumeric characters, and it will include the financial institution's legal entity identifier, or the LEI. Again, HMDA reporters will already have theirs. Next is application date. Again, very similar to HMDA. While the same methodology does not have to be employed for all reportable applications, the approach of identifying and documenting your application date should generally be consistent. Application method. The application method is by what means was this application submitted? Was it submitted in person, telephone, online, by mail? We're going to report how that application was actually taken. Now, application recipient. Was this application submitted directly to your institution or to an affiliate? Or was it indirectly through a third party or a broker? The next few, we're going to begin with action taken. So action taken, this is very similar to HMDA with just a very few exceptions. Our action taken is our final action that's taken. So we're talking originated, approved, not accepted, denied, withdrawn, or incomplete. So some differences under HMDA. Let's start with incomplete. An action taken of an incomplete application. Under HMDA, if it was denied due to incompleteness, we would report that as a denial as our final action taken. However, underneath this new rule, if an incomplete loan was denied due to incompleteness or an incomplete notice subject to Reg B was provided, we're going to be reporting that as an incomplete application. And then an action taken under this new rule, we have no purchased choice. There are no purchased loans or purchased loans underneath this new rule. What's similar with HMDA? Well, that's our approved, not accepted applications and our withdrawal applications. You know, how do you define those? Well, an approved, not accepted can only be reported when the application was subject solely to customary commitment or closing conditions. Now, just as in HMDA, that's going to be defined and give us lots of guidance on what those are. Those are typically when they're subject to clear title or maybe a subordination agreement, something where the loan has already been approved, all credit worthiness has already been approved. Everything has already been done on the loan application wise, meaning you already have your income, your assets, your everything with the property has already been approved. And then if a loan has been expressly withdrawn prior to satisfying all underwriting or creditworthiness conditions, you're going to report that as a withdrawn by applicant application. Action date. This is the date the final action was taken. The rule, again, provides much guidance for each individual type that an action was taken. And of course, documenting that is very important in your file, and consistency is key. I'll give you a few of the guidance that the rule has given us. First of all, for a denied loan, they give us the option to report the date denied or the date an adverse action notice was provided. For a withdrawn loan, they give us the option to report the date expressly withdrawn by the applicant or the date on the notification if it's a written withdrawal from an applicant. Approved, not accepted, they give us any reasonable date. So the guidance gives us some examples of what's reasonable. That could be the approval date, the deadline for accepting an offer, or the date the file was actually closed. Originated loans, well, of course, we're going to report the actual closing date that's on the note or the account opening date on our credit agreement. And for an incomplete loan, they tell us to report the date the file was closed or a date the denial or incomplete notice was provided. Now moving on to credit type. When talking about a commercial loan, we have an enormous amount of different credit types that can be out there, right? They're very different from a consumer loan. The rule gives us 10 different choices to choose from. Some of those examples are term loan unsecured or term loan secured, or potentially a line of credit unsecured or a line of credit secured. Of course, the choices will also include an other field. and a not provided by applicant or otherwise determined. As we very well know with the commercial loan, there's lots of negotiations that go on, lots of talking, and we just may not come to a conclusion on what kind of loan they actually or credit type they're actually going to obtain. Credit purpose, same thing. With the commercial loan, there's a million different reasons why they could be using these funds. They give us 14 different choices to choose from. We can report more than one, up to 3, and in any order. And then under this new rule, they also want to know what guarantee type. There's 13 different choices to choose from for guarantee type, and you can report up to a maximum of 5 guarantees. Moving on to loan term. The loan term will be recorded in a number of months. It's typically from the date of origination to maturity. However, if you have real property, you may use the months from the first payment to the maturity. So basically the number of payments in the amortization schedule. Now, these number of months can be rounded to the nearest full month, or you can count only full months. It's up to you. They give you it to your choice. But again, you should probably apply this methodology consistently. Amount applied for. This is your initial amount requested. Sometimes on a commercial loan, that might be a range. If it is a range, you're going to report the midpoint of that range. On those renewals, evaluations, or modifications that you're increasing the amount originally offered, again, not a refinance, and Brad did already define that for us. But if you're increasing the amount originally offered, you're only going to report the amount of the increase. You're not going to report any amount previously extended. If no specific amount was requested, that's common. We don't quite know yet. I know what I'm going to buy. I don't know how much I need, but the loan was actually underwritten, then we're going to report the amount that was underwritten as the amount applied for. Amount approved or originated. Obviously, we're not going to be reporting anything for denied, withdrawn, or incomplete. That's not applicable, right? So we're going to report only the amount originated or approved. Some examples the rule gives us. Under originated, a closed-end loan will be the note amount. An originated open-end loan, that amount will be the full line of credit or the that was approved or established. If there were multiple amounts approved, again, on a commercial loan, I may need 100,000 for this, but I may also want 50 extra thousand to do this. Perfectly fine. If multiple amounts are approved, and an amount that was chosen by the applicant should be reported. Now, if you had multiple amounts approved and no amount was chosen or accepted by the applicant, you're going to report the highest amount approved. And just with our applied for amount, if you're increasing the amount originally offered, not a refinance, you're going to report only the amount of the increase, no amount that was previously extended. And finally, on this slide, denial reasons. Again, with a commercial loan, much different than a consumer loan, we could have a voluminous amount of reasons why we're going to deny a loan. The rule gives us 10 different choices to choose from, and also a free form field that we can obviously write in what we are denying the loan for. Now, under a COA, it tells us that up to 4 is beneficial, but any more than 4 is not beneficial. So they give us a max of 4 to report here. The next field we would report is a census tract. Now, this is an 11-digit tract, and they give us kind of some information on, well, what property are we going to be obtaining the census tract and reporting on? Well, we need to apply this like a waterfall. So first we need to ask ourselves, what's the address where the proceeds of the covered credit transaction will be applied or would have been principally applied? So if I'm purchasing property A and I'm securing it with property B, my funds are being used for property A. So I'm going to obtain the census tract on property A, and that's what will be reported. Now, if that's not known where the proceeds are going to be primarily or would have been principally applied, then where the address or the location of the applicant's main office or headquarters will be reported. that census tract for that address. If neither of those are known, then we're going to obtain a census tract for another address or location that's associated with the applicant. Could be their home address. Now, census tract address type, obviously we've had to make a choice of what address we're going to use for that census tract above. So they just want to know which one of those choices did you use. The next is the NAICS code, or the North American Industry Classification System. We're going to be reporting the first 3 digits of this code, or what is referred to as the subsector code. They also want us to report, and they want to know the number of workers of the business. So how do we obtain this information? Well, we're going to ask the applicant. They give us some choices on what to ask the applicant. You can ask the applicant for the number of workers using the ranges that are specified in the filing guide. Some of those examples of those ranges are firms with no workers, 1 to 4, 5 to 9. And then, of course, it gets progressively higher, such as 100 to 249 employees or workers. Or you can ask for a specific numeric value. Now, what workers are going to be included? Well, this includes full-time, part-time, seasonal, and contract workers. They also want to know time in business. Time in business is going to be reported in whole years, rounded down to the number of whole years. And again, it gives us some information or some leeway on what and how we're going to collect that information. If you collect the number of years the applicant has existed, then you report that information. If for some reason the applicant, when you ask them and they tell you what the time in business, and they put that in the number of years the actual owners have been in the current line of business or current line of work, then you're going to report that information. However, if you've collected both of the above that I just talked about, then you're going to report the number of years the applicant has existed as the time in business. The next slide, we have gross annual revenue. Well, as Brad has mentioned before, the gross annual revenue is the applicant's gross annual revenue for the preceding fiscal year. Now, we can rely on a stated amount. So the applicant has either told us how much they make on their financial statement, or maybe, shall I dare to say, you have a loan application and they've reported it there. If it's just stated and that's all you have, that's fine. You report that amount. However, if you've verified the information, you're going to report the gross annual revenue that's been verified for the preceding fiscal year. Now, the next 8 fields are all regarding pricing information. These fields are only going to have actual values reported for originated loans or approved loans. The information for denied, withdrawn, or incomplete loans are either going to be reported as NA or left blank as instructed in the filing instructions guide, which they give us for each individual field. Let's start with the interest rate type and period. Obviously, this is where we're going to be telling the reporter, we're going to be reporting, fixed rate or variable. If it's variable and it has an introductory rate period, then obviously we're going to be reporting the period or in the number of months that that introductory period exists. Interest rate, if it differs based on the loan amount, then we're going to report the rate that correlates to the loan amount we just reported. We're just actually going to be reporting that actual interest rate. Now, for those variable rate loans, we have index, name, and value. There's 12 choices to choose from that's given to us, and a free form field. So if you don't have one of those that are given to us, you can report the what you do use. And the value that's going to be reported is the index value used to set the interest rate. The next is a margin value. So that margin, whatever your index plus margin is to calculate our interest rate, it's going to be only on a variable loan, and you would report the margin value that again is used to set the rate. Origination charges. Origination charges are all charges payable directly or indirectly by the applicant and imposed directly or indirectly by the financial institution. So this would include third-party charges if the financial institution requires the use of that third party, without regard to whether or not the applicant could choose said third party. So if you're doing a loan and you require they obtain lender's title insurance, it's a required charge. However, they can pick whatever title company they want to go to. This is still going to be included as a origination charge. The next field would be broker fees. Broker fees are the amount of the reported origination charges that are paid by the applicant for the delivery to a broker. Now, this includes fees paid to the broker, or maybe there's fees that are incurred that the financial institution or your institution is going to charge because you're brokering the deal to someone else. Either one, no matter if they're payable to the broker or your financial institution, those are included as broker fees and should be reported accordingly. Initial annual charges. These are non-interest charges that are scheduled to be imposed and payable over the first annual period, such as an annual fee on a line of credit. What is not included in initial annual charges, that would be any charges for avoidable events, such as late charges. And finally, on this slide, we're going to talk about prepayment penalty. Prepayment penalty is really a two-part reporting field. First, we're going to report whether a prepayment penalty could have been included in the program for paying all or part of the principal before the due date. So basically, does your loan program that you have available, does it include, could it have included a prepayment penalty, regardless of whether or not one is actually going to be included in that borrower or applicant's agreement. And the second part is we're going to report whether a prepayment penalty was actually included in the contract or agreement. So we know you could have included it. Did you include it for this borrower? And finally, on our last slide, we have some important information. We have some important fields here. It's important because it's extensively covered in the rule. There are a lot of pages that are given guidance on how to collect principal owners' ethnicity, race, and sex, and business ownership status. In fact, there's in the small entity guide, there's 30 pages alone that will give you information on how to cover those. So while I'm going to give you information, it won't be as extensive as what is included in the rule. Again, you'll have to just tune in and we'll possibly have more information for you in a later webinar. So let's talk about the number of principal owners. This is very similar to beneficial ownership, but we get a little bit of a break here. The number of owners that have at least 25% direct ownership interest, and that's where we stop, is the number of principal owners. We do not have to drill down to individuals. So that's up to 4, right? Principal owners, ethnicity, race, and sex. This is again similar to HMDA, but not quite exact. So one of the most important things that's covered in the rule when collecting this information is that the financial institution must maintain procedures reasonably designed to collect applicant provided data. Okay. That's including procedures to ensure that no one discourages the applicant from providing a response. And one of the warnings or cautions I'd like to put out there it is mentioned in the rule that a low response rate may indicate discouragement or failure to maintain reasonable procedures. And that, of course, can be subject to interpretation by those that view the data, such as your examiners. One big difference on HMDA is, as I mentioned, we're collecting applicant provided data. The lender is not allowed to collect the demographic information based upon visual or surname. Only report what is provided by the applicant exactly as provided by the applicant. Now, just as HMDA, we're required to give some notices when we're collecting this information. One of those notices is we must inform the applicant that the financial institution cannot discriminate based on the information. And we must inform the applicant that it is required by law that the financial institution ask for this information to help ensure that all small business applicants for credit are treated fairly and that in communities, small business credit needs are being fulfilled. Luckily, those are on our model forms that we'll be getting to at the next slide, right before I turn it back over to Brad. Now, the very last data point we're going to talk about is business ownership status. This is minority owned, women owned, LGBTQI plus owned businesses. So how do we define those? Well, if one or more minorities, women, or LGBTQI plus individuals directly or indirectly own or control more than 50% of the business and receive more than 50% of the net profits and losses of the business. Now, some disclosures we have to give while we're allowing our applicant to provide that information to us. You must provide the applicant with a definition of a minority, women, and LGBTQI plus owned business as defined in the rule. And again, it's included on that sample data form. And just as with collecting principal owners' DI information, you have to maintain procedures reasonably designed to collect, again, applicant provided data. We are not determining, they are telling us if they so choose, and then within those procedures to ensure that no one discourages the applicant from providing a response. And again, the rule tells us as a warning or caution that low response rates may indicate discouragement or failure to maintain reasonable procedures. So let's take a look at the collection form. So we have 2 pages of the collection form included on our slide. The first collection form is for business status. And then the second page is the demographic information for the principal owners. So obviously we could have up to 5 pages, right? If we have 4 principal owners plus the business ownership status. If you only have 3 principal owners, then you're only going to have 4 pages. So now that we've gone over a plethora of information, we know the when, we know the who, and now we know the what. Brad is going to be kind enough to tell us now how and where do we start from here. Brad?
All right, thanks, Sadie. That was good information. So as I'm sure you're all aware, Sadie just scratched the surface of these data points. As with HMDA, you can drill down pretty deep on several of them.